So as a business owner, it's easy to get caught up with jargon, and accounting jargon's even worse. So follow my video and I'll explain exactly what a fixed asset is for you and your business. If you haven't yet, click the bell and subscribe to be notified every time we produce our best pieces of content. As a business owner, you've got loads going on to make sure that you manage your business without getting caught up on understanding accounting jargon. So in this video, I'm going to explain exactly what a fixed asset is, why they exist and why they're important to your business. So what is a fixed asset? A fixed asset is something that you would recognise in your balance sheet under fixed assets. An example of a fixed asset can be a car, computers, laptops, machinery. If you're an engineering firm, a lathe, or if you're a construction worker, it could be a digger. But basically this asset is going to last more than 1 year. And where you would normally buy something and that'll be a cost in your profit and loss account, this is initially recognised in your balance sheet as a fixed asset. I would say regardless of whatever your size of business is, don't start recognising fixed assets that are under £250. I think it's just not worth it. Now, if you've got an asset that's lasting more than 1 year, so it's going to have a useful life, you'll be able to use it year on year on year on year, capitalise it, because that's how you are meant to recognise these assets within your accounts. Now, you would have a cost invoice come from your supplier. So an example could be Dell for a laptop, you spent £1,000 plus VAT. You would reclaim back the VAT from your business if you're VAT registered, and that £1,000 would go down as an asset within your business. Now, with an asset, you need to look at how long the useful life's going to be. And I'm going to stay on a laptop. So for me, a laptop is going to last you 3 or 4 years. Now I get some business owners like to squeeze the length out of their laptop to 12, but the useful life of where it's going to be fairly decent is going to be 3 to 4 years. So in your accounts, what you would do is you would reduce this asset over its life. Now this is going to be called depreciation. Depreciation is where you almost cut the asset into individual little pieces that go into your profit and loss account as a cost. So let's use the basic example. You buy a laptop that you've got a cost of £1,000. So you're going to have an annual charge go through your P&L account of £250 per year if you depreciate it over 4 years. Now, this choice is down to you, the director. Now, directors will always lean on their accountant, and so they should, to say, oh, what depreciation policies should we use? You may even say to your accountant, can you just deal with this as part of my year-end procedure? Whatever depreciation policy you use, my advice to you is make sure it's consistent with all other assets. So if you're depreciating computer equipment over 3 or 4 years, make sure it's the same every single year. If you're a construction business and you've got plant and machinery, you may want to do it over slightly longer. So it could be 5 or 6 years depending on the type of asset. But whatever you do, make sure this depreciation policy is consistent. How do I get my tax relief? You get your tax relief on the fixed assets currently at the minute under AIA, which is known as the Annual Investment Allowance. So what that does, you then classify the asset into different pots. Now, most of them are going to be part of general pool, but things to bear in mind of, tax relief on a machine that's going to last more than 50 years is taxed at a different rate. Make sure you bear this in mind. Another classic one is if you have a motor car, that will be taxed in a different rate, in a different pool at a different rate. So make sure that you're not assuming that you're going to get all the tax relief in year one, because under AIA, and this has been this way for a really long time, most small businesses get their tax relief on the asset in year one. Now that's amazing. You buy an asset for your business which allows you to grow, it allows you to thrive, and you get all the tax relief in year one. This is a real opportunity. Now, there's no saying that this tax relief will be the same in the future because it changes. Back many, many years ago when I was training as an accountant, I remember when assets, you got a first year allowance of 50%. It does change, but who knows when or if it will. When you have assets within your business, this normally means that you're investing. It allows you to do things quicker. It allows you to do things better. It allows you to improve on efficiencies. So a construction business, the more tools they've got, the quicker they do the job and the better they do it. like us for an accountancy firm, if I invest heavily in computer software, computer equipment, my team get to do the job quicker and better. That means that they can have better conversations with our clients to help steer them and give them the support that they truly need. So when you're looking at your business, one thing to bear in mind is, yes, we all want to make loads of profits, but make sure you are not falling into a black hole where you are under investing in your business, because ultimately, longer term, it will have a detriment in the quality that you deliver to your customers. So please bear this in mind. If you've got a business that's growing, you'll be investing. Now, fixed assets can be a very sizable investment within your business. You don't always have to buy these physically in payment in full. There are various providers that will allow you to finance certain assets. So if it's got a tangible value, you can almost bet your bottom dollar you will be able to find a company that will be able to finance these assets. Now, ideally, it's amazing to pay these out of reserves and out of cash, but a fast growing business has to keep a really good control on cash. So when you're looking at investing in assets and you haven't quite got the money yet, please consider finance. There's loads of asset finance companies out there that can provide you the finance to give you the assets to help grow your business. So within a growing business where cash can sometimes be a bit tight because it's invest, look at finance. There's a wealth of options which may allow you to get to where you want to quicker. How do I keep an eye on these? You keep an eye on these by having what we know in the accounting terms is a fixed asset register. In layman's terms, this means a list of your assets, how much they've been depreciated for in current years, how much they've been depreciated for in this year, and you have a net book value. The net book value is cost less depreciation equals net book value. And that net book value will be the amount that you'll see sitting on your balance sheet at whatever month or year end you're looking at. Now, it's important to make sure that you keep an eye on these assets. Although you will estimate your depreciation policy over a certain amount of years, there are some times where they'll break and they'll be rubbish and you have to throw them away. So periodically, at least annually, you want to be looking at your fixed asset registers to say, have we got all of these assets? Have they broken, or have potentially some of them been stolen, gone walkies, got lost? It could be a whole range of reasons. So make sure, as you, the business owner, are recording your fixed asset registers so you know everything that you've got, to making sure that you're getting the most value out of these assets and you have everything in your control. Hope you found this video of interest, and if you've got any questions that I can help with, please click my Calendly link below. I promise to answer all of your questions, get to know you a bit, and I promise there'll be no pushy sales pitch.